What if I told you that the next global financial crash might already be known? Not by economists, not by analysts, but by artificial intelligence. That somewhere, deep inside the data centers of Wall Street, algorithms are silently watching every market move, detecting invisible patterns and warning signs long before human traders ever notice them. This isn't some futuristic conspiracy, it's happening right now. While most of the world reacts to headlines, AI is already predicting tomorrow's chaos today. And the shocking part? The institutions that control this technology aren't sharing what they know. Financial markets have always been driven by one thing: information. Whoever gets the information first wins. But in the last decade, something dramatic changed. Wall Street replaced human intuition with artificial intelligence. Systems capable of processing trillions of data points per second. From news articles and stock tickers to satellite images and even social media posts, these AIs are devouring every signal they can find, searching for one thing: the next crash before it happens. In this video, we'll uncover how AI actually predicts market collapses, which secretive systems Wall Street firms are using, and why some experts fear this technology could cause the next crash instead of preventing it. Let's dive into the hidden world of AI on Wall Street, where machines rule and milliseconds can mean millions. 1. The rise of the machine traders. Before AI, Wall Street was ruled by floor traders, shouting, waving, and making deals. Now, those traders have been replaced by servers, algorithms, and supercomputers. More than 70% of all trading in US markets is now handled by automated systems, many powered by AI and machine learning. These systems don't just trade fast, they learn, adapting in real time to global events, news sentiment, and even tweets from world leaders. One major hedge fund reportedly has an AI model that tracks over 5,000 global variables at once, everything from commodity prices to temperature data in China, to anticipate economic stress before it shows up in human analysis. These AIs don't sleep, they don't get emotional, and they never miss a signal. And in a market built on psychology and panic, that makes them terrifyingly powerful. 2. The hidden early warning systems. In the aftermath of the 2008 financial crisis, Wall Street made a promise: never again. So they built something extraordinary: AI-based early warning systems designed to detect market instability before it spirals out of control. For example, JP Morgan's LOXM system was designed to predict optimal trades by analyzing billions of past transactions, but soon evolved into a tool for spotting anomalies in market behavior. Goldman Sachs uses deep learning models to forecast volatility and liquidity, identifying when investors start showing fear patterns in their trading. And BlackRock, the world's largest asset manager, runs a secretive AI engine called Aladdin, which monitors over $20 trillion worth of assets. Aladdin's job? To simulate thousands of what-if market scenarios every day, from interest rate hikes to geopolitical wars, and warn the firm before things break. To put it simply, AI is now the financial equivalent of a weather radar system, predicting economic storms before they arrive. 3. Reading the markets like a brain reads emotion. But AI doesn't just crunch numbers, it reads moods. These systems use natural language processing, NLP, to analyze the emotional tone of millions of financial documents, earnings reports, and social media posts. If traders suddenly become negative, if the language in news articles turns fearful, or if certain phrases start trending, and the AI notices. It quantifies human emotion and converts it into measurable data. This field is called sentiment analysis, and it's one of the most powerful weapons on Wall Street today. One AI model even predicted the 2020 market crash 5 days before it happened, simply by detecting a sudden surge in negative sentiment across financial news feeds and Reddit forums, before the world fully realized COVID-19 would halt the economy. In essence, AI has become the nervous system of the global market, sensing emotional tremors long before humans feel the quake. 4. The power of alternative data. Traditional traders look at stock charts, earnings, and company reports. AI traders look at everything else. They track the number of cars in a retailer's parking lot using satellite images. They analyze supply chain data to detect product shortages. They even monitor how often people mention a company in online searches or how long delivery trucks idle outside factories. This is called alternative data, and it's the lifeblood of the AI trading revolution. In one instance, an AI model from a hedge fund accurately predicted a drop in Apple's quarterly revenue weeks before the official report, just by noticing a decline in parking lot traffic near Apple stores worldwide. These AIs don't think like humans. They find connections no human brain could ever process, turning global chaos into profit. 5. Predicting market crashes before they happen. So how does AI actually predict a crash? It's not about seeing the future, it's about recognizing statistical signatures that always appear before financial collapses. For example, a sudden increase in correlation between unrelated stocks often signals panic. Spikes in liquidity stress can mean that money is drying up in the system. And unusual patterns in options trading can expose insider fear before the headlines hit. AI models constantly watch for these red flags. When enough appear together, the systems start flashing internal warnings, sometimes days or even weeks before public analysts react. Some of these AI predictions are so accurate that firms guard them like national secrets. They'll quietly shift their portfolios, short the market, or move billions in assets, while the rest of the world has no idea why prices are suddenly swinging. To them, it's not a crash. It's an opportunity. 6. The dangerous side, when AI becomes the crash. But here's where things get dark. The same systems that predict market crashes can also create them. Because AI models don't just observe, they act. And when hundreds of algorithms make similar decisions at the same time, the results can be catastrophic. We saw this in 2010 during the flash crash, when automated trading systems caused the Dow Jones to drop nearly 1,000 points in minutes, erasing almost $1 trillion in market value before rebounding. Today's AIs are even faster and more connected. If they collectively detect panic signals, they might all start selling at once, amplifying fear and triggering the very crash they were built to avoid. It's a feedback loop where the machines begin reacting to each other. A digital herd mentality capable of shaking global markets in seconds. And because these systems are black boxes, even the engineers who built them can't fully explain why they act the way they do. In other words, Wall Street has created an AI ecosystem that's both brilliant and dangerously unpredictable. 7. The secret AI race between hedge funds. Behind closed doors, a new kind of arms race is unfolding. Not for nuclear weapons, but for data supremacy. Every major hedge fund is racing to build the most advanced AI prediction model. Citadel and Renaissance Technologies are hiring astrophysicists and AI researchers instead of traders. Bridgewater Associates is using reinforcement learning to simulate how different human behaviors could trigger future recessions. Even smaller firms are renting AI models trained on decades of economic history, like digital oracles of Wall Street. These AIs are not just reacting to markets, they're competing to control them. And as each firm builds smarter systems, the entire market becomes a complex web of machine-to-machine interactions. A global casino where algorithms play against each other, betting billions in microseconds. The question isn't just who will win, it's whether humans will even be able to keep up. 8. The future. AI as the ultimate financial oracle. In the near future, AI won't just be predicting crashes, it'll be running entire economies. Central banks are already experimenting with AI-driven policy simulations to anticipate inflation and unemployment shifts. Governments are exploring AI models that could monitor national economies in real time, preventing recessions before they start. But the ultimate dream for Wall Street is a fully autonomous trading ecosystem, where AI systems handle every aspect of finance, from investment to risk management with no human input at all. If that future arrives, markets won't be driven by human greed or fear anymore. They'll be driven by algorithms that define their own logic. That could mean stability, or it could mean the next crash won't come from a housing bubble or bad loans, but from a glitch in the code. The truth is, Wall Street's use of AI isn't about predicting the market. It's about controlling it. Every time you see a sudden drop, a strange rally, or a mysterious sell-off, there's a good chance it wasn't sparked by human emotion, but by an algorithm quietly making moves millions of times faster than any human ever could. The real danger isn't whether AI can predict the next crash. It's whether anyone can stop it once it begins. Because the deeper AI integrates into global finance, the more our economic future depends on systems we don't fully understand and can't fully control. So the next time markets start shaking and experts look confused on TV, remember this: somewhere, a machine probably saw it coming.